Welcome to the deep dive. Our mission, as always, is to take this really dense stack of market reports, policy analysis, and some pretty crucial corporate updates.
And just boil it all down.
Exactly. Boil it down into the core knowledge you need, not just to catch up, but to really get a sense of the direction of travel.
And if you look at the material today, that direction is all about tension. I mean, we are in a deeply polarized environment. On one hand, you have policy signals that are getting, frankly, highly experimental.
Especially on the fiscal side.
Oh, absolutely. But then on the other side,
You've got this massive, sustained, and honestly accelerating infrastructure build-out, and it's all being fueled by the certainty of AI demand.
and that contrast, that's what defines where the money's moving, and I think where the biggest risks are right now.
Yeah, that makes sense. So to set the scene a little, the market tone this morning kind of suggests that investors are trying to hedge against that exact tension.
You've got U.S. indices that are, modestly green, which shows some underlying strength. But what's interesting is that small caps are doing better.
While at the same time, gold and crude are firmer.
Exactly. And that whole setup, risk appetite plus commodity hedges, it tells you the market is okay with taking risks, but they're only doing it if they're also insuring against all this global uncertainty.
And that uncertainty is pretty clear when you look globally. Japan is strong, but Hong Kong is weaker.
Right.
It's not a unified story.
Far from it.
So our job today is to cut through that noise, try to understand the real financial implications of this policy drift, and then pinpoint the corporate growth stories that are just accelerating anyway.
It's all about separating the signals, what's just short-term political noise versus what reflects genuine long-term economic investment.
Okay, let's unpack that policy side first, because this is a story that has been gaining some serious traction. The White House is apparently exploring a proposal for a $2,000 dividend?
Yeah, a $2,000 dividend for eligible taxpayers. And the idea is that it would be funded entirely by existing tariff revenue.
So the question is, why is this drawing so much immediate fire? Politically, giving money back to households sounds like a pretty easy win.
The scrutiny is just unavoidable because the whole thing rests on a monumental fiscal arithmetic failure. It completely undermines the entire reason they gave for the tariffs in the first place.
Which was what? To reduce borrowing?
To reduce reliance on borrowing, yes. This scheme just flips that logic completely on its head.
Okay, so give us the numbers. How big is this gap between the handout and the actual revenue?
Well, if you look at a one-off payment, that $2,000, and you apply the same kind of eligibility we saw during the pandemic.
Right.
The estimated cost is somewhere around $600 billion.
$600 billion, okay.
Now, compare that to the annual revenue we expect from all the current tariffs. That's roughly $300 billion.
So the giveaway costs double the income. So wait, if the government takes that tariff money and just recycles it into transfers, the deficit doesn't narrow. It actually gets wider.
It actively widens, and that's the massive contradiction. This proposal takes money that was supposed to offset borrowing and just repurposes it for political visibility.
And it creates an even bigger hole.
A much bigger hole. And that's before we even get into the structural distortions. Tariffs just complicate supply chains. They raise input costs for American companies.
And we know from the sources there's not much evidence that these tariffs have sparked some big manufacturing revival, right?
Very little evidence of a broad revival, no. And remember, the administration originally claimed that foreign exporters would absorb most of the cost.
But the data doesn't show that.
No, the data is clear. Households are bearing a meaningful share of that cost through higher prices. Businesses are feeling the margin pressure.
So this $2,000 dividend is really it's a very visible one-time thing that says, we see your pain, but it doesn't fix the underlying cause.
Not at all. It's a Band-Aid. And it's a Band-Aid funded by more borrowing.
And for investors, that has to set a worrying precedent.
It's a very clear signal of increasing policy experimentation, where, the political win of a short-term cash handout just takes priority over any kind of established fiscal discipline.
And if this actually were to move forward, what would the market reaction be?
It would be a definitive negative signal for U.S. fiscal discipline. It could put pressure on the bond markets, and you'd probably see it as a mild positive for inflation hedges and what we call long-duration risk premia.
Okay, let's pause there. Long-duration risk premia. That's a pretty technical term. How should we understand that?
The easiest way to think about it is, when you see government policies that suggest less fiscal restraint, Investors start to worry about future inflation and long-term instability.
Sure.
So long-duration risk premia are just the assets that do well in that environment. Things like certain inflation-protected bonds, gold, or even stocks of companies with really secure, predictable future cash flows.
So this kind of policy drift just makes those long-term hedges look more attractive.
Exactly.
It's a perfect way to frame it. And those massive policy risks are, well, they're exactly why investors are so desperate for areas of guaranteed growth. Which brings us to our next segment, the absolute explosion in AI infrastructure.
And this is where the corporate momentum feels completely detached from all that political noise.
Right.
We are seeing phenomenal growth, and a great example is this Netherlands-based data center operator, Nebius.
The Nebius story it's just remarkable. They've secured these massive contracts with the big hyperscalers, Meta, and most importantly, a $17 billion agreement with Microsoft.
$17 billion. It's not just the size, it's the structure of the deal. It represents a deep, long-term commitment. It shows that Microsoft isn't just renting space. They are locking in highly specialized, GPU-optimized infrastructure for years to support their own AI models.
And the market reaction has been explosive.
Oh, completely. The stock is up something like 248% year-to-date. It's pushed their market cap over $25 billion.
And their management is expecting the whole AI infrastructure market to grow by a factor of, what, 10 to 100?
That's the projection.
So what makes Nebius so valuable? I mean, beyond just owning the real estate.
Well, they're a perfect example of what you'd call a second-line infrastructure provider. They sit just one layer below the mega clouds like Microsoft or Amazon.
I see. So they partner with someone like NVIDIA for the GPUs.
Right, for the crucial hardware. And then they sell the optimized space and connectivity to the hyperscalers.
So for an investor, this gives you exposure to all that AI CapEx, but through data centers, not just by betting on one chip maker or one software company.
It diversifies the bet, exactly. They are the facilitators of the boom, and they're building a model that's trying to anticipate future volatility.
How so?
They're focusing on higher margin services, not just rent, and structuring these long-term contracts. So if there's a slowdown in general tech spending, AI workloads will probably be the last thing that gets cut.
Okay, that shift from political risk to corporate acceleration is crystal clear.
Yeah.
Now, let's talk about a major area of divergence right here at home, the U.S. labor market. That ADP private payrolls data for November was a huge surprise. It completely missed expectations.
It was a very, very telling snapshot of the economy. The data showed private payrolls actually fell by 32,000.
Fell?
Declined, yeah. When the consensus was calling for an increase of 40,000, it was the largest net decline we've seen since March of last year.
And this number really highlights that whole two-speed labor market idea, doesn't it?
Sure.
Where was the pain concentrated?
The pain was heavily, heavily concentrated on Main Street. Small firms, so companies with fewer than 50 employees, they shed around 120,000 jobs in the month.
Wow, 120,000 jobs lost just in the small business sector. That's a huge pullback. What did ADP say was driving that?
They pointed directly to cautious consumers and just general macroeconomic uncertainty. Small businesses operate on thinner margins, you know. They're more dependent on immediate cash flow.
So they're the first to pull back on hiring when things look soft.
The very first.
But the big firms were telling a totally different story.
A completely different story. Large companies, the ones with the capital to weather a storm, they kept hiring. They added roughly 90,000 positions. It's a deep, deep split.
So what does all this mean for the Federal Reserve? A negative payroll number like that usually shifts the odds of rate cuts.
It definitely raises the stakes for the Fed, yeah. Softer payrolls absolutely increase the probability that they'll move toward easing sooner rather than later. It lines up with how the market is already pricing things.
The market's already expecting a cut at the next meeting.
It implies a high chance of one, yes.
But, while the stock market might cheer rate cuts, there's a real consumption risk here, right? If small businesses keep shedding jobs at this rate, what's the long-term threat?
The threat is sustained weakness in overall consumption. I mean, if 120,000 jobs disappear from small firms, that's a direct hit to household income and spending power.
And large company hiring can't fully make up for that.
It can offset some, but it can't compensate for a wide-scale retraction on Main Street. The Fed has a really tough balancing act now.
Okay, let's shift our corporate focus to software. We have earnings from CrowdStrike, which is always a great barometer for IT security spending.
And the CrowdStrike numbers are just a clear sign that security is a non-negotiable budget item. Net new annual recurring revenue, or ARR growth was 73%.
73%.
Yeah, which is a massive acceleration from just 18% a year ago. Total ARR was up 23%.
And the really impressive part to me is how they're scaling their business model. They're moving customers to this modular pricing, the Falcon Flex model.
Which grew 200%. It's now 27% of their total ARR.
So for the listener, what does modular pricing actually mean for them and for CrowdStrike?
It just means breaking the product down into specialized components. So instead of buying one massive security suite up front, a customer can start small, say, with basic endpoint protection, and then just bolt on other services as they need them.
Like cloud security or identity protection.
Exactly. It makes the budget more granular. And for CrowdStrike, it makes the revenue way more resilient. A customer might adjust the modules, but they're not going to cut the whole relationship.
Right. Now, what's interesting is despite raising guidance and all this strength, the stock was down a bit.
Yeah, and that wasn't weakness. That was just expectation management. The stock had already rallied more than 50% this year.
So it ran into a valuation wall.
The bar was just incredibly high. It's not a failure on their part. Security is still a critical line item.
Absolutely. Okay, let's wrap up our corporate look with a completely different kind of scaling. Waymo.
Autonomous mobility. Yeah, Waymo is really moving past that proof of concept stage now.
We're seeing a clear shift to network scale testing. They're expanding manual test drives to 3 new cities, Baltimore, Pittsburgh, and St. Louis.
And this expansion is super strategic. It's not just putting pins on a map. These markets expose Waymo to completely different driving challenges.
So Baltimore has the old, dense street grid.
Pittsburgh has all the hills and complex bridges and confusing intersections. And St. Louis gives them cold weather, snow, ice, all of that.
They're actively stress testing their models against the toughest variables. And this brings them to, 26 markets total?
26 markets, active or planned. It's all about building that footprint. And it comes right as Zeus is offering free rides and Tesla's introducing its ride-hailing service.
So for Alphabet, Waymo is this huge long-term bet on the future of urban mobility.
A potentially transformative one, yeah. But it requires just a vast amount of complex real-world data to succeed.
What a contrast we've covered today. I mean, you have this policy drift toward these really experimental fiscal ideas that could widen the deficit.
And then you contrast that with these robust long-term CapEx commitments in AI and autonomous tech.
And then there's that deep split in the labor market. Big companies are thriving, but small businesses are facing a really severe contraction.
It is the two-speed economy in sharp relief. And if you're taking one thing away from this deep dive, it should be that immediate tension. The tension created by that soft labor data, that 32,000 job decline, and the pressure it puts on the Federal Reserve.
So what's the actionable thing here? What should you, the listener, be tracking next to build on this?
I would track the specific language from the Fed governors leading into their next meeting. The market is aggressively pricing in a rate cut.
Right.
But we need to hear if the employment worry, that small business pullback, if that is now officially outweighing the risk of persistent inflation in their minds. The tone of that discussion, that balance, that's going to dictate market sentiment for the next few months.
That focus on the Fed's shifting balance, a perfect final thought. Thank you for joining us on this deep dive.
My pleasure.